to the cloud. All right, I think we're good. And as more people pop on, we'll just get rolling here. So I want to start by introducing our expert panel for today's year-end real estate roundtable. So today we are honored to have Ali Alavi of Alavi and Braza PC, which is a boutique law firm specializing in real estate matters and representation in Massachusetts. He is a founding partner along with his lovely wife, Gina Braza, and has 20 years of experience in real estate law and an unflappable sense of humor. It's just very important, especially in this time.
Especially these days. Thanks for having me, Carrie.
Hey, Ali. Good to see you.
It's awesome to be part of this great panel.
Yes. Thank you so much for making the time in your busy schedule. And we have Rick Shearer, who is here joining us. He is a CEO and senior mortgage planner of Onto Mortgage, which he founded just in 2019 after a long time working at MSA. And the company is growing in leaps and bounds. He specializes in working with first-time buyers and real estate investors, cultivating lifelong relationships as a mortgage advisor to his clients, not just a broker. And his company is founded on a culture of personal growth and also of community, demonstrated by his many philanthropic activities. So welcome, Rick.
Thank you so much for including me. I really appreciate it. Looking forward to it.
Thank you. And we have Jamie Thompson, who is a real estate agent and property manager at Thompson Realty and director at GBAR, Greater Boston Association of Realtors. And Jamie has his finger on the pulse of the local rental market and works tirelessly to maximize his clients' investment portfolios. With his 18 years at Raytheon and also his present service to GBAR, he brings a level of technical expertise and professionalism to real estate that is very rare in our industry. So welcome, Jamie.
Thank you for having me, Carrie.
Thank you so much. All right, so now that we're all here, I just want to dive right into kind of the meat of the topic here, which is to break down the events of 2020 related to COVID, the pandemic, and real estate, especially in our market. So I want to jump right to Rick, since the mortgage industry, as well as the current rates, are really driving the market. So Rick, what I'm hearing that mortgage rates will be staying low throughout next year and maybe even the next 2 years. And I wanted to hear what your thoughts are on that.
Yeah, it's a great question. And it's the million-dollar question, right? Is what's happening with interest rates. So I'll tell you, as far as what's happening, what I think is going to happen between the end of this year and next year is, the government is essentially keeping mortgage rates artificially low. So, what I mean by that is typically mortgage rates are really determined between the markets. So mortgages are bonds, and you get the stock market. So we always knew that we were going to have a really good day in the bond market when the stock market came down and bond market went up, and vice versa. It was going to be a bad day if the stock market rallied and bonds got worse. Right now, what's happening is quite frankly, I don't even put on CNBC anymore because that doesn't matter anymore. The government is buying up billions and billions of dollars of what's called mortgage-backed securities. What that's doing is it's keeping mortgage rates artificially low, right? So it's hard to predict what's going to happen with the market when you've got a third party really coming in and really controlling that. So so what we've been told is the government is really going to be using mortgage rates in order to get us out of, this recession that we're going to be, this economy that's going to be, suffering for a little while due to COVID. So we do know, we've heard that the prime rate of interest, that's what controls your credit cards and your car loans and your equity lines, things like that. The government, that's what the government can control. And they've moved that down to the lowest point possible, which is a 3.25% rate. They've said that they're going to keep that low until 2023. How long they keep mortgage rates low, again, they haven't come out and said it's to a certain point. However, because we know they're going to use this to spark the economy, we do have a sense that rates are going to stay low probably until second to third quarter of next year, from the people that are way smarter than I am are talking about.
And by next year, you mean 2021, right?
2021, yeah, correct.
Okay. Can I ask you, so is there any, it sounds really good, rates being low, but are there any negative effects on the economy or at all?
So there's
Low.
Yeah, there's not necessarily negative effects on the mortgage side of things, because really what it's actually a really good positive thing that's happening to homeowners right now, because what they're able to do is, they might have been at 4%, 5%, 3.5%, and now what they're able to do is ratchet that debt down into the 2% range. Now, there's smart ways to do it, right? And so certainly you want to talk with a mortgage advisor to make sure that what your goals and objectives are, and make sure you're doing it correctly. It's a great time to restructure your debt. If you can pay off a lot of high interest credit cards and still get a mortgage in the 2%, high 2% range on a 30-year fixed, could be a great thing to do. A lot of people are also taking advantage of saying, okay, well, I got into a home 4 years ago, right? I don't want to go back to a 30-year mortgage, start that interest clock again. So they're using it to go to a 25-year or a 20-year, and some maybe even to a 15. So they're utilizing you're either wanting to save monthly payments, on a cash flow, but you're resetting that clock back to 30 years, or saving a little bit, or maybe paying a little bit more, but saving them the interest over time. So I don't see any downside to mortgage rates being low. Now, the prime rate of interest, is, keeping that low can cause, inflationary things. And, obviously we're not making any money on savings accounts or CDs or things like that, but it is keeping our consumer debt low. So the positives are definitely outweighing the negatives.
Yeah, I mean, I just was talking to a first-time homebuyer client today who she just locked in a mortgage rate today of 2.875, which is amazing. And she was saying, she's telling her friends about it because she has people in her life who've been saying, well, I'm saving for a home, I'm thinking about buying a home sometime in the future. But it's like, if you're thinking that way, maybe talk to a mortgage professional, or definitely talk to one, and just see how much the low rates affect your payment, and can you do it sooner due to, it's like,
Carrie, yeah, you hit the nail right on the head. One of my biggest frustrations is the lack of information out there to the consumer around down payment. I get so frustrated when I have a client will call me and say, I find, and this was a couple of years ago too, when rates were on the rise, and it was like, I finally did it. My grandmother told me I needed that 20% to put down, and I've been saving for 3.5 years, and when you peel it back, you're like, well, if you got to me a year ago, I could have gotten you a lower interest rate and not had any PMI, because we would have done we would put you in a better position a lot sooner. So we definitely want to beat that drum out there that if you're a first-time home buyer, there are 3% down options for you, and where rates, like you said, are still in the twos, you're paying that rent. But if you have less than 20% down, the PMI word used to be a dirty word. I'm not paying mortgage. I still have people today, I'm not paying mortgage insurance. Okay, but when you find out that the mortgage insurance is $43, it allows you to keep 20 grand in your pocket. Your pocket. Let's not get stuck on the word PMI. Let's just figure out what everybody's situation is. And man, if you have that ability to take the step into home ownership today, there's not a better time as far as interest rates go and affordability goes.
Yeah, and we've definitely seen that. I mean, the third and fourth quarters of this year, nationally, home sales have been 20% higher than last year in the third and fourth quarters of 2020. So people are jumping on the bandwagon and taking advantage of it. It's been a booming real estate year despite the pandemic, and that's largely because of the interest rates.
Oh, 100%. And if you think about it, just a 0.5% in interest rate, could be the difference of $30,000 or $40,000 more in buying power. So if you were out there pre-approved at 3.25% or 3%, and now you can get down to 2.75 or 2.5 in some, in some instances, that's 30 or 40,000. Keeping that payment, your budget, monthly budget, the same, that equates to some pretty big numbers. That might get you into another bedroom, might get you into a home that's on a cul-de-sac as opposed to a main road. So, definitely if there are anybody out there thinking, hey, could it be possible for me? Like I said, definitely reach out to a mortgage advisor, someone that that you can trust to go through that. They might say, hey, makes sense for you to wait another year. Or they might say, hey, you could have done this last year, but let's get you with a real estate agent. Let's have you give Carrie a call and find out what's available to you, because like I said, rates have never been this low. And so we need everybody taking advantage of it, even if it's first time home buyer or ratcheting your industry, getting you in the best situation possible for your mortgage.
At least look at it, at least be informed and know your options. So you're not, looking back and going, oh my God, I wish I had.
Shoulda, woulda, coulda. The thing
Right.
is, again, if you pulled the trigger at 3.5, you say, oh, I missed the market. I did. Well, but if you had 3.5, now we can refinance you. It's always trying to catch the bottom, right? You never want to try to catch a falling knife, right? That'll hurt you. So it's not like, hey, I'm going to sit here until rates go to 2%. No, that's not the way you want to do it. You want to pull the trigger when it makes financial sense, but be ready to ratchet your mortgage down when the time becomes available. So that's what we're doing right now. Even clients that we purchased back in January of this year, or February or March before COVID hit, we've already refinanced those people. We've already brought their mortgage rate down and reduced down their overall expenses, and for many of them with no closing costs. So you want to just always check in with the mortgage advisor just to check out your situation and see if it makes sense.
Awesome. Great. Well, I want to keep the roundtable going. Jamie, I'd love to check in with you because in property management, you definitely are right there on the front lines of what's going on with rents in the market around here and what landlords are doing in regards to the eviction moratorium. I wondered if you could kind of give us your perspective on what you're seeing in the rental market and maybe how landlords are handling what's going on if they're having to mitigate risk or loss. Can you talk about that?
Absolutely, Carrie. Thank you. So rental market right now, obviously the student market created a lot of vacancy for the Boston area. We did see a lot of professionals that left the Boston area to move out. They can work from home. So they've moved outside of the greater Boston area, lots of moves to New Hampshire, Vermont, middle and Western Mass, just save money and also get different amenity sets since basically Boston services are closed. They didn't have the things that they were looking for in the area. What we're seeing is basically an across the board 15% drop in rents at the moment with some extended time on market, 60, 70 days in some places.
I'm sorry. Can I just interrupt you one moment? Just can I ask you to give your market area that you serve, your service area?
Yep. So Eastern Middlesex and Northern Suffolk is our primary business area. So what I say, Boston to 95 and Woburn to the water. So we are seeing that type of behavior where rents, the market has felt the impact of people leaving the Boston area. We're expecting that to come back once people start returning to Boston and things start opening up. But you've got to take into consideration that the people that left the area either have returned home with their parents or may have leases elsewhere. So if they've got a year lease somewhere else, they may have to break that to come back to Boston or wait until that lease ends, which could be next September from a time frame. Talking to companies in the area and seeing what companies have announced, schools are seeing students coming back to campus, September timeframe. They're looking at limited in-person, on-campus activity through the fall semester. Companies are seeing September as a time frame, even possibly December of next year as really a return to the office, and that is only going to be a percentage. There are going to be allowances for working from home in those situations, as well as remote students. So what owners are doing to mitigate losses and risk, Retention is your number one item here. What some of our owners have done, especially when the pandemic started, that March to May timeframe was real decision point for owners to make a decision on what they were going to do for retention. Some owners may have offered a reduction in rent, maybe a free month in order to mitigate impact early. Another option is to look at amenity improvements. We've talked to tenants and said, what would improve your, tenancy here? And, laundry on site, in-unit laundry is a big thing. Open spaces, if the property has backyard space, improving that space, adding patio space, things like that. Upgrades to the unit, new appliances, or feature set, digital key entry, things like that, where it improves the convenience of the unit for the tenants.
Basically, it sounds like it's become a more competitive landscape for landlords. So they're having to improve the condition or lower the rent or both in order to make sure they keep tenants, right?
That's correct. The vacancies in the market have created opportunity for tenants to look elsewhere, and they consider it. Obviously, moving does have an expense for the tenant. They've got a moving expense. If they've got a lease that they've committed to, then there might be a cost for breaking that lease. So there are expenses that make it a challenge for the tenant to move, but they do consider those costs when they're considering an opportunity to rent somewhere else that may have different amenities at a lower price. The other consideration those tenants need to take into account as well is that once the market returns, those properties' rents will likely return to their previous prices, or at least go up percentage more than they saved in this round.
Jamie, are you seeing tenants sort of giving their notice and take advantage of the rates that Rick is talking about and utilize this as an opportunity to get out of Dodge and perhaps buy in the burbs?
So we manage about 120 units right now. I've seen two tenants that have decided to buy from in the market in general. We've definitely seen the general Boston area, greater Boston area, people that have been saving to buy take the opportunity now, especially with mortgage rates and rent. They've moved Western Mass. And as you guys know, the inventory in the market is low, so the demand is being pushed up higher and you're seeing those competitions for properties. It's a high competition rate right now. Our rates on the properties that I've been managing, we haven't seen a lot of vacancies. I think out of the 120 units right now, we've got 7. That was some that have decided to buy, some that have decided to move. We've got tenants that moved cross country recently. They moved out west. So there are other decisions that normal market behavior that are still occurring.
Well, that doesn't sound bad at all. You said 7 out of 120.
Yep.
Vacant.
Yeah. So I mean, the tough part is the vacancies, getting those units re-rented because of the availability in the market and the demand and the options. Also because of people not making as much money as they may have been. Trying to re-rent those units, especially in a winter market, is the biggest challenge right now. We're hoping to see that come back up in the spring. We're working on, right now the best things to do are amenity options that you don't have yet that are that other properties do have that are competing. What's your laundry situation? What appliances are in the units, and also bringing the rents down. Really, if you need to have if you are at risk from a vacancy right now and you need to get those rented, the best options are either investing in the property. Again, as you guys have talked, mortgage rates are low, refinancing the property, taking some cash out to reinvest in the property and bring it up to a competitive market model for that unit, or bringing the rents down in order to get the units rented now.
Awesome. Thank you, Jamie. Ali, I'd love to put you on the spot now. As an attorney, and you're in the thick of things with, doing closings for refinances and also for buyers and sellers. Are there any specific legal ramifications or risks that are specific to COVID that you see?
Nope. I'm kidding. No, of course. The COVID, the pandemic, the the risks that are associated with all of that created tremendous layers of challenges, and all of those challenges amounted to risks. And so we had to manage those risks. We had to contemplate for how you deal with those risks, and contemplating with regards to those risks in the contract itself, and contemplating for those risks when it comes to the actual practical sense of doing closings. So on a contractual side, yes, we ended up adding a number of different provisions, contemplate for a lot of different sort of scenarios where potentially a buyer could fall ill to the virus, or the seller could fall ill to the virus, for the fact that there would be a stay-at-home order, courthouses could be closed, and as a result of that, potentially the documents wouldn't be able to get registered or recorded. The stay-at-home order really challenged the ability, the workflow of the transactions itself. Smoke detectors were not being successfully inspected. Final water sewer bills were not being issued by towns. Municipal lien certificates were not being issued by towns. Sellers had tremendous trepidation with regards to allowing access of buyers once they had the property under agreement because of the risk of exposure, etc. And so we had to contemplate for all of those types of scenarios in the contract itself. We were fortunate enough that we were able to successfully have open dialogue with our title insurers to be able to allow what's called gap insurance. And gap insurance was offered to them at no cost. And gap insurance, for those who may not know, is an insurance policy offered by the title insurer at no cost, which allows the closing to move forward, dispersing of the files to move forward. In other words, the seller getting the money, the seller's mortgage being paid off, the buyer getting the keys, in the event the courthouses are closed and will not accept the registration of the documents. So there are very specific steps that we have to take in order to be able to take advantage of the gap insurance. But it certainly was a game changer, and it certainly facilitated a lot of the closings from happening. You know, for the audience that may or may not know, there's recorded land and registered land. Some of the registered land does not allow electronic recording of documents. And if a courthouse is closed and you can't deliver these documents to be registered, then you're in a bit of a pickle. And so gap insurance allows us to be able to facilitate the transactions from moving forward. So that was definitely a game changer. You know, contemplation of delays, we had to add provisions to the contract that really wouldn't prejudice the buyer's deposit if things happened that were completely beyond their control. I mean, if there was no smoke, there's no final water, there's no municipal lien certificate, or if a party falls ill. So we added specific extension provisions that would contemplate for that.
Great, great. Have you had anyone that's gotten in legal trouble and a direct result of COVID?
I mean, fortunately, no. I think one of the surprising things that have come out of this is that I think both sellers and buyers realize, and I think people in general realize, the sort of the unprecedented times that we're dealing with. And I think as a result of that, they understand that lenders like Rick's team, although he has a phenomenal team around him, I mean, they're at their capacity as far as the volume is concerned. And I mean, and it sort of trickles down. I mean, they're ordering appraisals. Appraisers are out there. They're not being granted access to do an appraisal because the seller's fearful of COVID, you know, and they also have, you know, tremendous amount of volume behind them. Inspectors are underwater with the volume of business that's out there. So all of this sort of trickles down. And I think people realize that there are certain natural bandwidth restrictions that's associated with the transaction. You sort of couple that with the delays that may be forthcoming as a result of COVID. And so I think people in general have been very flexible and very understanding to what's going on. That's been, it's been surprising to see and watch. But no, fortunately, we really haven't seen much legal risk, if you will, that our clients have been exposed to. We've had situations where people have fallen sick. I mean, not they haven't fallen ill, but they've contracted the virus and they couldn't literally come to the closing, and we wouldn't want them to anyways. And so thankfully, there's an emergency statute that was put forth by the legislature, which allows for remote notarizations. And so we've been able to take advantage of that remote notarization statute to be able to facilitate those transactions from happening as well. So things have changed, but we've managed.
Which is awesome. It's pretty
Yeah.
impressive. Well,
I think Ali made a great point about the remote notarizations. I mean, from a technologies perspective, I think the pandemic has definitely pushed all of our businesses, mortgage, legal, and real estate and rentals and property management, to really adopt technologies that have been in the market to improve the processes for our clients and for me, for the tenants as well. Those have really helped with making the processes more streamlined. I won't say faster, because there's definitely some scenarios where delays, like Ali said, inspections and things like that, trying to get those accomplished. I see the same thing with a lot of my contractors trying to get work done in properties. We don't do any emergency work right now in units if the tenants don't want somebody to come into the unit. That way we don't have those exposures there. I'm sorry, we only do emergency work. We don't do any general work unless the tenant is looking for it to be done. That way we limit the exposure. So if it's, a gas, water, electric, something like that, we'll get those taken care of, but we try to avoid contact between vendors and tenants. From a technologies perspective, I think, Rick, you probably see the same thing on the mortgage side. Online signing, for us on rental side, video tours, virtual tours have been a big adoption item that we weren't using in the past. 3D tours as well, floor plans, things that we weren't generally using because we didn't need to. You didn't need to implement those in order to get the deal done. But now with people looking for property on sales and rentals, you're seeing that demand they want as much information as possible before they come to the property, so that they don't have to risk an exposure during the walkthroughs and things like that.
Yeah, I mean, they say necessity is the mother of invention, right? And like Ali said, in Somerville, for example, I don't know if this is still happening in other cities, but it definitely in Somerville, the tenant can refuse a showing or any visit to the home. So I just dealt with this in a 3-family in Somerville where we literally could not show that unit. We could not have an appraisal or an inspection through that unit. So, but the deal did move forward just based on pictures and a floor plan. So it's been interesting, navigating the market, but it's happening and it's working.
So Carrie, since this is a roundtable, let me ask you a question. So Carrie and Rick and I have had the pleasure of working together for many, many years, and we're both, we admire working with one another. We also consider each other friends. Our industries respectively are considered essential. How do you feel about being essential, being deemed essential, and how have you been able to navigate the process?
Well, it was a huge relief when I heard that back in the spring. I don't know if it was March or April or May, but I was very, very grateful. And I appreciate it because I think, people's real estate, in terms of whether it's their home or an investment, is such an important part of their life and sometimes their livelihood. So, their health is obviously the most important thing, right? But then I'd say right up there is your financial life. So I'm grateful that it is recognized as an essential service, and I'm still able to help people in that way. And I think there's a lot of opportunities in this market too, which hopefully we can talk about a little bit today. We talked about the interest rates, and they say that the Chinese character for crisis is the same one as for opportunity. Well, I think that's very true here. If you can embrace the opportunities in this market, then it could be setting you up for a lot of good years ahead.
I couldn't agree with you more. So you're deemed essential. I know that as a law firm, we had to take very, very specific steps of making sure that not only our employees and ourselves were safe, but also our clients were safe. But what are some of the steps? What are some of the precautions that you've taken to ensure that your buyers or your sellers are safe in this current climate?
Yeah, well, particularly in the very beginning, we were doing a lot virtually, a lot of interactive video tours and floor plans. That became something we did with every single listing, so that we were really weeding out people instead of, before COVID, it was like, bring everybody, bring the neighbors and everyone who wants to take a look at a home, come to the open house and let's have a big party at the open house. That completely changed to let's make sure just the people who are actually going to make an offer come down and see this property in person. So we made sure they'd seen an interactive video tour. They'd seen the floor plans. They'd thoroughly investigated the house as much as they could from their own home, or maybe checked out the exterior, and they were pre-qualified and thoroughly vetted as a buyer. And then, yes, we can do a showing privately, one by one, with all the PPE. So it was a very different dynamic of safeguarding people's health, at the same time trying to maximize the proceeds for the seller. So it was kind of walking that line, but we found a way to do it very safely. And as we became more used to the situation and it became a new normal, I think, I don't want to say we've lightened up, but we've just become a little more used to it. So it's like, yes, whether, if the home is vacant, it's a little easier. We can, kind of arrange a showing as long as everyone's wearing masks and socially distancing at any time. I've had clients who have left their home for 2 weeks and gone to stay with family while I showed the property. And that, of course, makes it a lot easier. And then, some clients prefer to do just private showings staggered throughout the course of a weekend. Some prefer to accumulate all the showings together within 2 or 3 hour window. But again, it has to be one by one going through the home, or at least socially distancing. So it's kind of the same way you'd go to a grocery store. You just make sure you're following all the CDC guidelines and being a little extra careful because it is, someone's home in the long run.
Yeah, we had to contemplate provisions in our purchase and sale agreements to address that, because as you know, whenever an offer is made and we negotiate a purchase and sale, the purchase and sale allows for access, and at times unlimited access, at times, and so we had to really restrict the number of access and really flush out sort of what are some of the steps that a buyer needs to take in order to have that access, or what are the agent needs to do in order to have access. And that was something that we had to do it immediately. And a lot of the sellers had tremendous amount of reservations in having just unlimited access to their home while this craziness was going on.
Yeah, I think just everyone has to be conscientious, and we're not inviting parents to bring their kids in the home and things like that. So it's definitely a much more controlled environment when it comes to any type of showing or visit to the home.
Yeah.
But I think, and then you have like service providers like inspectors or contractors or appraisers, and in my experience, everyone has been very adherent to the guidelines, and very conscientious, because probably like me, they're grateful that they are able to still work, and they want to make sure they continue to do so. So I've had good experiences.
Yeah, if I can just jump in on that, Carrie. So some of the things that had changed as far as on the lending side of things is the appraisal piece of it. We've always, for a very long time, we've had things what's called appraisal waivers. And, I say that a lot of people go, oh, here comes 2006, 2007, here we go. Well, what Fannie Mae and Freddie Mac decided to do 10 years ago is they created databases. So every time that a loan was going to Fannie Mae or Freddie Mac, you would have to upload the appraisal up into their system. So if you can imagine, when they're originating 85% of the mortgages out in the marketplace, that's a lot of data. So what they've decided to do is now that they understand the market data, they understand the neighborhoods, the properties, then what they'll do is if we put an address into the underwriting software along with a purchase price, they check it against their data. And I would probably say on refinances, we're seeing it about 65% of the time. On purchases, I'm seeing it about 35 to 40% of the time.
You're seeing
Appraisal waivers.
Appraisal waivers. Okay.
Yeah. So I'm putting an address in along with a purchase price, and it goes into its little algorithm, and it will come out and say this qualifies for an appraisal waiver, meaning
Oh, wow.
we don't need an appraisal to go out there. And
Wow.
so they did this for a couple of different reasons. We have a very hefty purchase market right now. We also have an extremely, like we've never seen before, refi market. And appraisers are, there's not a lot of them. The barrier to become an appraiser is like 100 hours of class and like 2 years of apprenticeship. So what you're seeing is appraisers are much older than, and there's not a lot of people getting into it. So what the Fannie Mae and Freddie Mac from the beginning said, hey, listen, we got to stay ahead of this because you have all of these people refinancing and you still have a purchase market, and we have a finite amount of individuals. So what you started to see when this first hit is, place in California and in Colorado, appraisers were $1,500, $2,000 because you had a limited amount of people to do a certain amount of production. So they've adapted. And so we're seeing a lot more appraisal waivers happening. We're also seeing a lot of drive-by and desk appraisals that we can request. There's pros and cons to that. Theoretically, when people are doing a drive-by or they're doing it from a desk and doing it pictures and things like that, you're not getting sometimes you're not getting maximum value because they don't get to go in, see how the layout is, look at the, how the property is, quality of the property is in. Maybe they might miss a bedroom or bathroom or something. So it's not perfect, but that we've made some adjustments on the appraisal side too.
Now, with the market being the way it is, I just looked at Massachusetts yesterday. Single families are up almost 10% from this time last year, which is a huge amount of appreciation, and definitely leading the market. Condos are pretty stable. They're only about 1% higher, and multifamilies, I believe, were about 5%, which is really good too. Are you seeing a lot of appraisals coming in short with the purchase prices being the way they are?
So no, we're not, because there's a lot of cash in the market. So cash don't need appraisals. So if they say, the property's listed. So for instance, I had a single family in Arlington that was listed for $850,000. It went for $1,050,000, and it was financed. He had a lot of money to put down, but it was financed. And I gave him the heads up. Hey, this might be pushing it. It came in at $1.1 million. So, the market is a little crazy right now, but because of all of the activity, it gives the appraiser a lot more data points to be able to back into different values. So we're not seeing a lot of appraisal misses. And the ones that we're seeing, it's the listing agent calling us every 5 minutes going, hey, did you get the appraisal back yet? Hey, checking in. So, we're not necessarily, if you're overpaying for it, everybody knows that, listen, you're swinging for the fences here. But for people that even, and that's the other thing that I always hear about, Carrie, is I'm not going above purchase price. I'm not going to go above asking price. And I always say to them, well, what is asking price? That doesn't mean anything. It's a starting point, right? Yeah. And so, people get so like, I'm $1 over. No, because at the end of the day, there's a lot of, great agents that say, hey, it's $900,000 property, but let's do it at $875 and let's everybody bet against each other. So if you're going, I'm not paying any more than $875, well, it's not, so it's really looking at that data. And one thing I'll just add, based on your statistics of single families being a lot higher and condos, still doing well, but not being as much. And Ali and I, we used to have a radio show on WBZ, and we talked about this all the time. And it was the empty nesters, Wellesley, Weston, Woburn, Braintree, saying, you know what, kids are out. I'm going to the seaport. I'm going to Back Bay. I want to walk to dinner. I want all of that. And we saw a mass exodus, from the baby boomers and all heading into the city. Well, we're seeing the reverse commute right now. We're seeing people that, I have a neighbor that moved. Actually, I have two neighbors that moved from bigger homes, moved into the city, and they went from 6,000 square feet to 1,500 square feet, and they're going, all right, it's a little claustrophobic now. I gotta get back out, and so we are seeing the condo sales in the city, and then people moving back for the yard, for the space, for their kids and all that type of thing. So anyway.
Can I jump in here real quick? Sorry, Carrie, but a couple of weeks ago I was chatting with someone who is in the business, was representing a sale of a very significant commercial property here in the city, and the buyer was having a really tough time finding financing for it. They didn't have a financing contingency. It was a very, very significant commercial transaction. And it was one of those acquisition construction type of scenarios. They ultimately found the financing and they ultimately was able to close. But sort of segue to Rick, are you seeing sort of credit crunch restriction, sort of the guidelines getting a little tightened? Are you seeing any mortgage products that were available and that are not available now as a result of this? Has everything changed there?
A lot of meat on that bone. So I'll go quick because I don't know what
else. These are the questions that I ask, man.
It's so let's talk about product first, real quick. When the downturn happened, two products kind of went away very quickly, or at least got restricted. One was what's called non-QM, non-qualified mortgages. These are people that are self-employed, that people that were bank statement loans, all the out of the box quirky stuff. There was a market for that. But when COVID hit, and the market is investors, people in Wall Street, securitizing, securities and selling them off. That was one part. Jumbo loans. So anything over in this market right now, we just went up to 724,000 and higher in the Boston market on a single family home. Anything over that money is jumbo. In other words, institutions securitize that. When COVID hit, both of them said, you know what? I have no idea what's going to happen. Is the jumbo market going to get crushed? Is the people with $1 million mortgages, $2 million, $3 million mortgages, are they going to not stop paying us? And they're more risky loans because there's less of a bulk. So if you have, 100 go bad out of 1,000, as opposed to the smaller, the bigger bulks, less risk. So those are the two things that went away. Now, non-QM has started to come back, and jumbo mortgages have started to come back because they've realized that those aren't the people that got affected by COVID. The business, some business owners, certainly in hospitality and services, but a lot of people didn't. So those will come back. What has changed, restricted in the market? Definitely around employment. Unemployment is at record highs. Sorry. People are losing their job without a moment's notice. And so in the beginning of COVID, we would have, the lenders would want to verify a couple of days beforehand, then the day of closing. Now think about that. You're calling an HR person who is now working from home, and no one knew how to do that yet, and do it effectively and efficiently. You're calling at 10 o'clock in the morning to get a hold of HR before you release the funds for a purchase closing. It was a nightmare. Because the number one thing a lender does not want to own is a mortgage of someone who can't afford it. So really around employment was the biggest stickler. Another thing was self-employed borrowers. So a self-employed borrower, they're really hard to wrap our arms around their income, because what happens is if you're 1099 or you have income that's kind of up and down, we never know how much you make. So you tell the federal government, hey, my taxable income was this. Okay, but remember, it's lagged, right? So 2018, right? You took all your stuff and you told the IRS what you made in 2018 and 2019, and then so for us, we know that for self-employed borrowers, a lot of people were struggling. A lot of people were hurt. So if it was June of 2020, the only way I could tell on how that self-employed borrower was doing was looking at 19. I can't do that. It's a totally different market, totally different situation. So for self-employed borrowers, it did get harder, and it is harder for now. What we want is
Attest to that.
what's that? You can attest.
I can
Yes.
attest to that, having just refinanced with you.
Yes. Yeah, because they want to say, okay, because we can't tell what your income is until next year, how COVID affected you. How do we figure this out today? It's a year-end-date profit and loss. It's, hey, I've made all this money. Here's been my, and we're not making it audited or anything like that. It's, but they want to see the bank statements to back it up, the money flow into your account. Right?
For the record, the law firm is not doing the VOE. Okay, buyers. So don't blame us.
You getting beat up?
We get this question asked all the time. Like, why are you doing my VOE so last minute? Well, we're not doing it. Okay. And number two, I think it is not a last minute thing. It's not as though the lender are on to sort of waited around and didn't want to do it. I think it's a regulatory thing where you are required to do it the day of the closing. So it's done by design to make sure that you weren't laid off that morning. So,
that's right. And people were getting laid off that morning, by the way. It was a pretty scary time. The last thing I'll touch upon, because I think it happens for people that currently are owners, is forbearance, right? So we got this thing, the government came out. Now forbearance was different than in 2008. In 2008, if you had a hardship, you had to say, hey, I'm unemployed, I have a hardship. I have hey, let me take that one extra step and show you that I can't pay my mortgage, can't pay my bills. This one, they kind of just said, you don't have to prove it. You just have to just call up and say, I want a forbearance. The problem there happened is if you took a forbearance on your mortgage and you didn't want to pay it for 4 or 5 months, the lender still had to pay it. You can imagine if you've got billions of dollars of mortgages, you didn't have the money coming in, but yet you still had to make the payments to Fannie Mae and Freddie Mac no matter what happened. Lenders got scared. What's going to happen to my portfolio? Can we afford it? Government, Fannie Mae, Freddie Mac came in with some backstops. They weren't perfect. But what happens is now lenders said, if you want to refinance your mortgage, you're looking to buy a new home, but you're currently in a forbearance, what you're telling me is you can't afford your mortgage today. Why am I going to give you a new mortgage? So there were people that could afford their mortgage and said, hey, let me hold on to my interest for an extra couple of months in my bank account, and I'll skip a couple of mortgage payments. That backfired. Forbearances didn't hurt people's mortgage credit score, but they reported it on your report as a line item saying this loan is in forbearance. So right now, if people are in forbearance, one of two things have to happen. They either have to pay up all the money that they owe up front and make one on-time payment before you can refinance, or you need, so some lenders will allow you to attach it to the back. What then they were looking for is 3 on-time payments after it's attached to the back end of your mortgage. So my whole thing is if you need a forbearance is much better than getting late on your mortgage. So if the alternative is not paying your mortgage and being late, forbearance is what you need to do. However, if you can make your mortgage payment, make your mortgage payment. Don't, because it did take people out of the running for refinances, and they're like, I've got $1 million in the bank. They just said I could do it. You want to pay your bills if you can pay your bills. If you can't, it's a great option to
and if you can't afford to make your payments and need to do a forbearance, make sure that you review the documentation that the lender gives you very, very carefully to figure out all the various impact that could potentially have on your credit. How is it being reported? Is it going to be due once the forbearance is over, or are they going to actually tag it onto the back? I think it's important for you to review that documentation before you sign it, before you agree to do a forbearance anyways.
Yeah, I think that's really good information. Thank you for touching on that. I wanted to make sure we touched on that. I also want to make sure that we get into a little bit more of what we see in the trends in the market, or what we see. None of us has a crystal ball, but maybe what we are, experience tells us will happen in the coming year in the market. So at the crux of that maybe is, how is this current situation different than 07, 08? Do we think there'll be a lot of foreclosures coming around the pike? So Rick, I have to go back to you on this one first. So do you think this is different than 07, 08?
I do. I think that, recovery, I think, is going to be a lot faster, just because you have a lot of the supporting factors. You still have people still have equity in their homes. People still have, a lot of people have lost their jobs, but getting new jobs and trying to stay in that marketplace. So yes, I think we're going to find it. We're going to see foreclosures. You've got landlords who can't pay their rents because their tenants aren't paying, and so you will see some fallout from that. But if you remember, the downturn was for quite a while. I think if we can stop the health crisis, that we've got, we can start to rebuild on that. And so I think help's on the way there to some degree. Again, for mortgages, I do anticipate rates going higher. I can't imagine if the government allowing rates to go higher until it's ready, until like they start to see signs of growth and come back. And then I think once they do that, they'll slowly inch us up. So mortgage rates, I think we've got some runway here. That's not to say like wait on the sidelines. There's certainly a cost of waiting to do something, but I think as a whole, mortgage rates are going to be fine if we can get the pandemic under control. You're going to start to see things relax on the requirements around self-employment and mortgage products. So I tend to think that we're going to be in good shape for a little while here.
I mean, listen, the situation of what we're dealing with now is different from 06, 07, 08. The mortgage products that were available were incredibly risky products, 100% financing, no income, no asset verification type of loans, etc. And I think a lot of people fell victim to that when there was a correction. And I don't think that those mortgage products are prevalent or available anymore. So I think that's a big differentiating factor between what we're dealing with now and what we dealt with in 07, 08. My prediction, I think that divorce attorneys are going to make millions. I think that bankruptcy attorneys.
Are you switching careers, Ali?
I am not. I think that bankruptcy attorneys are going to make millions. I do think that there is going to be a correction in the bend. It may not be imminent, but I think over the course of the next probably 12 or 14 or 16 months, you're going to see a correction. And I wholeheartedly agree with Rick. I think that the recovery is going to be much more quicker. My heart goes out to the hospitality industry and how their industry has just been devastated by this virus. And I agree. I think once the vaccine is here, and once we do see that herd immunity and all that, and I think once sort of the paranoia subsides and people feel safer and more comfortable, and they can go back to the restaurants and hotels, etc. And I think you are going to see a recovery there, and I think it's going to be quicker than we saw in 08.
Yeah, I think more people having equity is a great point. That was not the case back in 07. There were a lot of people that, like Rick mentioned, had no down payment or very low down payment mortgages that they simply couldn't afford the payments on, and that was the real issue going on at that time. Whereas right now, with the extra precautions and regulations in the mortgage industry, as well as a lot of built up equity, the past 9 years or more, that we've seen so much appreciation that homeowners have quite a bit of equity on average. So they shouldn't have to foreclose. But of course, yes, there'll be some. Jamie, what about you? Predictions?
So, similar in the rental market, I think that we're going to see the strength of the rental market in Boston is initially student driven, as you closer to Boston for the colleges. That opened up a lot of property to other renters. I think the schools opening back up to in-person learning, and then businesses opening back up are going to be the big drive for rental market to return. So I would say that's looking towards the end of next year for those people that have lease ending that period of time. Going into 2020, so the end of 2022, 2023, we're going to see the rental market, I think, start to return to normal as the students return, as Boston opens, people start going back to work in town and start making decisions to move closer to work again.
Jamie, I'm hearing sort of like conflicting stories. you see, and again, this, don't hang your hat on the number itself, but I hear, annual losses that are reported by Airbnb, like $500 million. And then at the same time, I hear
Airbnb that
that,
just went public and doubled their stock price.
exactly. And then at the same time, I hear that short-term rentals are actually attractive. That you're seeing more activity on short-term rentals because of the fact that you get visiting nurses and hospitals that require visiting nurses, and their sort of period of occupancy is only for a month or so, and then another one sort of rotates in. Are you seeing any of that trend on the rental side of things?
I get calls for short-term rentals, but they're very few and far between. I don't see strong demand, but I also don't target that market. So my exposure to that is limited. I would say I've gotten more calls for a 3-month, 6-month term than I have probably in the past few years. I think that's more for people that are coming into the Boston area from other cities. They're thinking Boston's where they want to be from New York or from California. So they want to move into Boston for a short term, get to know the area. And they don't want to be locked in where they go, because they're going to move once they get comfortable in the area, figure out where they want to land long term.
Yeah. All right. Makes sense.
Yeah, I mean, I always look at supply and demand as generally the biggest factor in determining the market, and the inventory, has been really tight in our market in Greater Boston over the past at least 5 years. But this year it's just exacerbated by the pandemic, and it's really, really tight right now. So it is very localized. So it depends whether you're, right in downtown Boston or you're in the suburbs, whether you're talking about a condo or single family and all that. But in general, the inventory is just so tight. It's a seller's market. And so I think watching that dynamic, as well as the absorption rate, is going to be key in determining what happens next in our market as far as prices go. That's one of the major predictors. And we were talking right before we went live here about the fact that I do think there's a pent-up demand, even though there's been such an active market this second half of the year. There are also a lot of sellers I've been talking to who are waiting until the COVID is passed and the vaccine is widely available, and they don't want to deal with it right now. So I imagine and predict that there will be kind of this pent-up demand of sellers as soon as we see that vaccine widely available. I don't know if that will counterbalance the inventory, where it will shift the market. I don't know. I don't know that it will, because again, it's such a tight market. But in some sectors of the market, it may. Maybe in the
Carrie,
city. I'm not sure.
Sorry. Just had a quick question, Carrie. Could you speak to just quickly what you see in the investment market with condos and multifamilies? Do you think that's going to be something that's going to be similarly impacted by increased inventory, or after this is all done?
Yeah, I mean, there has been a rise in inventory and an increase, or a decrease, I should say, in absorption rate for both condos and multifamilies. So there's been a gradual increase in the inventory in both of those sectors of the market. So, and again, we're still in a seller's market. So anything less than 6 months supply of inventory is considered a seller's market. But for the first time in years, we're seeing over 2 months of supply in condos, for example. So it's sort of gradually shifting. So I'm just keeping an eye on that because at some point, it could tip the other way.
Right. I mean, so as a firm that represents buyers, sellers, and developers, what I can tell you is that on the developer side, we have developers that are doing condo projects. We have developers that are doing single family projects in the burbs, and they're not slowing down. We don't see them slowing down. They're not slowing down in terms of acquisition of opportunities. I think it's very difficult still for them to find good opportunities. But, you know, I had a transaction whereby my client had sold a property that he was gonna develop before he even bought it. Like, that's how crazy the market in the burbs has been. My prediction, I think, for 2021 is that I think you're gonna see an increase, a rise in the amount of, hopefully amount of new stock, new inventory, because the developers are so keen in continuing to acquire and build.
I know.
Yeah.
And Rick has a great weekly newsletter that goes out, and I just saw it, I think it was yesterday, saying that there's been less, flips happening this year, but the profit margin on those flips has been like the highest ever. So for
Right.
the people that were, brave
How
enough
come,
to do
how
it.
come I don't get the newsletters?
You unsubscribed a long time ago, my son. No, but one thing I'll just add, I mean, I have a client buying in Duxbury right now, well, $1.5 million. And the developer had put, I think, about 6 lots. He put 3 on the market. 3 were gone by the afternoon. And so I was like, hey, is he getting any lots? He's like, he's probably not releasing those until he gets, these 3 done. But I mean, it's this pandemic is really causing people to rethink where they're living. And also, one other thing I'll mention is, I'll tell you, there's a lot of people leaving Massachusetts because they can work in Massachusetts and they can live in Florida, in Georgia, in the Carolinas, on the beach for what they're paying in their condo in Boston. So, there's a little bit of that happening. I'm hearing a lot of it, like, Converse, right? I have a bunch of clients in Converse, hey, they're going to make a decision if we can work from home forever, then, hey, we're going to Southern New Hampshire, or we're going to the Cape, or we're going. So it's, and I think people still want to be in the city. So I don't think that the city's going to collapse. So it's just a lot of moving parts.
But that's a great segue, though. I mean, we are seeing a lot of second home transactions. I mean, you look at what's going on in the market down the Cape. A lot of our clients that live in the city are buying second homes down the Cape because they, like Rick said, they don't necessarily want to commit to leaving the city because they realize that it's a temporary situation. And if they do have the luxury of wanting to buy, to have the ability of buying a second home, a lot of them are exercising this. I mean, one of your team members, Rick, Pam Silver, her dad is like Mr. Cape Cod, and I was listening to his sort of monthly or quarterly report on what's going on, and it's unbelievable what's going on down the Cape with regards to how everybody is sort of gravitating over there because they can work remotely and because they feel safer.
Yeah.
They're
Remember 2 years ago
accomplishing
you told me to sell my Cape house, and I did. Yeah.
Yeah.
I went to.
I didn't tell you that. I did not tell you that.
Listen, if you ever want to know when not to sell your property, you just call me and I'll tell you when I'm doing it. Because 2012, I sold my 2-bedroom, 2-bath in South Boston, right? 425, went for 700,000. And then I went to go buy another Cape house this year, and I go, wait, it's like another 60, 70,000 more down there. So, yeah, definitely. I mean, it's there's a finite amount of land, and we are seeing people need that second place, that place to go with their family. The pandemic has opened up this whole psychology around, just taking a deep breath. Like, life is short. Where do we want to be? How do we want to live? And so
and interest rates are still very aggressive on second homes as well, right?
Interest rates are the same exact. Your interest rate on a single family home is the same exact as a second home. So yeah, if you want to go buy a second home, put 20% down. Actually, for some degree, you put down 10% on a second home. Your rates in the mid to high 2% range.
I love Yvonne's expression. She's like, "Whoa, really?"
Yeah, we're seeing it.
So. I know we're over time, and I want to respect everyone's time. But let's see. I did just want to mention too that yes, there's definitely going to be, and there is more flexibility for geohacking, which is like that term for people working remotely and working from different states or even different countries, because they don't have to be near the office. Or if when we do return, to a more normal situation, maybe they have a hybrid schedule where they're working a few days in the office a week and then the rest at home. So they don't mind a longer commute. So I think the bottom line is people have more flexibility and will have more flexibility going forward in a lot of professions where they don't have to be in the office every day. So we'll definitely see that trend continue, right?
Yeah, no, absolutely.
Maybe.
I think so.
Maybe. I mean, I think it depends on who you talk to. I mean, you
Yes.
talk to some of these think tanks, and I was on a podcast for Pavaso, and I don't know to what extent you guys are familiar with it, but Pavaso is essentially, it's a company that was created by the ex-CEO of Zillow and the co-founder, the founder of Dotloop, right? And it's for essentially shared second home ownership, right? But that's not the point. The point is that as a technology company, they are yearning for people to come together. They are yearning for those bubbler conversations, because that's what stimulates creativity and new ideas and all this. And I think I don't know to what extent you're going to see this outward trend of let's not do a brick and mortar type of thing, Rick.
So, I started the company, 14 months ago, 7 employees. We're up to 32, and I have 7 that are out of state. I've got 2 in Georgia. I've got 1 in Florida. I've got 1 in Maryland. So as a business owner, what this has allowed me to do, right, is I'm forced to, I can go outside of the talent pool here in Mass and go and find talent pool somewhere else. So I agree, I agree with you that, man, it'd be really great to have the team in the office and have the team, but we're going to figure out a way. We have our Christmas party coming up. It's going to be virtual. We've got this whole thing planned. It's breakout rooms and trivia, and we're going to have a fun time based on what, where we're at. But companies are going to figure out how to hack into that. So yes, certainly being in the office is number one. But you're going to have, I feel a lot of people are going to still have that remote aspect to it.
Interesting.
And I'm just going to lob this one last comment or question out to whoever wants to take it. With all the economic stimulus that has happened this year and may still happen, do you believe that inflation at some point is inevitable with that down the road?
100%.
Okay.
I mean, this is totally Rick's in Rick's wheelhouse, so I'll let him handle that one. But I'll tell you, you can't be printing money without significant ramifications down the road. I would say inflation is around the corner. And I think that's one of the reasons Rick was mentioning about the fact that interest rates are going to rise eventually, because you can't just pre-printing money.
Yeah, well, I'll just jump in real quick because I don't know we're jumping out of time. But yes, the Fed uses the Fed funds rate, the prime rate of interest, that 3.25% that I talked about. They use that to curb inflation. So, they can't keep that rate low forever, and to control inflation, they need to move that higher to help out in that inflationary rise. So, again, they've really come out and planted the flag. When I say they, the Fed has come out, but that's going to change hands. You got Janet Yellen coming in, and you got a lot of, so that might change. But they're saying 2023 they will see that rate stay low. We'll see how fast the recovery happens, but then you'll probably start to see that thing move pretty fast up, as long as the economy is on recovery. If they move that up too high and too fast, you could see a double dip recession, and we can jump in on all that. It's a whole nother podcast, webinar. But that it is something that is going to be an issue, because printing all that money, you got to absorb it somehow. Which
is a great reason to invest in real estate. It's one of the best hedges against inflation. Invest in an asset such as real estate, where you have a fixed payment over 30 years. And you can have Rick, Ali, and Jamie on your team managing your property and there to consult when you have questions and when you need expert advice. So you've got your power team right here. And I know you guys put, Rick and Ali, you put your information in the chat. I'll also get everyone's information out via email as well. So you can feel free to call them directly, email them directly to find out more, or talk about your specific situations. thank you guys so much for being here, taking time out of your busy schedules. It really means a lot. So thank you. And it's great to see you as always.
Thank you,
Thank you for
Carrie.
having us,
Thank
Carrie.
you for
Thank you.
allowing us the opportunity of sitting on a panel and
Yeah.
sort of exchange ideas. This has been great and a lot of fun.
Thanks so much, Carrie. Appreciate it.
Yeah, no, definitely. I could do it all day, but we'll, we'll let you go for now. Thanks
Thanks.
again.
All right. Take care.
Bye.
Take care, everybody.
Bye.